All right, accounting for bond premiums in this video. Just a reminder, like the issuing at a discount, we are going to issue at a premium, and by that we are saying the sale price of the bond is going to be greater than the face value, right? So again, face value, par value, same concept. But we're saying, listen, the face value or the par value is 100,000, but we are going to sell the bond for more than that. In this example, we're going to sell the bond at 103.6% of the face value. And the reason investors would choose to pay more than the face value is because we are offering an interest rate that is greater than the market rate. Okay. So we are offering a stated rate of 12%, whereas everybody else or the market is offering 10%. So we're paying more interest than everybody else. So we're going to have a ton of demand. And since we have so much demand, we can afford to increase the price. And the way that we will determine how we increase the price, we will learn in another video. But for now, we just want to account for how do I record the sale of the bond, and then how do I account for interest, okay? The next slide, this slide, there's too much information in this slide. So I think what I want to do is, again, just use my own screen. Okay, so what I'm saying here is the face value of the bond is 100,000. Okay. The stated rate is, I want to say that it was, what is our stated rate? Our stated rate is 12%. Okay. We're going to pay semi-annual, meaning we will pay twice a year. And then the maturity date is 2 years. The maturity date is 2 years. And then finally, the issue price, we are going to issue at 103.6%. 100 I'll just do this. 103.6% of the face value. So the journal entry, well, let me actually, before we get to the journal entry, why don't we just sketch out a chart? So what we're saying is, hey, listen, we're selling for more than the face value. Okay, we're going to sell for 103,600. And then over time, right, the amount that we are obligated to pay back is going to go down. Remember, we are only obligated to pay the face value at the end. And we are borrowing 103,600 today. Okay? So let's do the issuance of the bond with this in mind. So the cash that we are going to get, the cash is 103,600. That is the issue price of the bond. Okay. And then we obviously have bond payable, and that's always going to be the par value or the face value. And now we have a bond premium, right? We actually borrowed 103,600. And if somebody wanted their money back immediately, we would pay them 103,600, not the face value. So I have to do a bond payable premium, and that will be 3,600. And then, like we were saying on the discount, the longer that we hold on to the bond, the less valuable or the less money we are obligated to pay. So that premium is going to shrink. Remember, the premium, 3,600, is going to go down over time. Okay. So the journal entry to record interest expense, okay, it's the same set of procedures. The first thing I'm always going to do is I'm always going to calculate the cash paid, okay? And the cash paid is always going to be the stated rate times the face value, and our stated rate is 6%, right? That's the 12% annual rate divided by 2 since it's twice a year, and the face value is 100,000, and therefore the payment is going to be 6,000. And is that right? Am I doing the math right? Uh, no, I'm not doing it right. Actually, wrong slide. Sorry. I am doing it right. I'm optimistic. Um, Premium on bond payable. Bear with me. Here we go. Yes, I'm retarded. 6% times 100,000, 6,000. You would think I could do that in my head, but I can't. So anyway, we are going to credit cash for 6,000, right? That's step one. Then we said step two, we are going to eat into the premium, and it's just going to be the same thing we do with the discount, but opposite, right? So we will take the total premium divided by total periods. And the total premium was 3,600. And the total periods, since it's a 2-year maturity date and we're paying semi-annual, it is 4 periods. And 3,600 divided by 4, I think is 9. 900? It is 900. Okay? And remember, the premium is a credit. When we issued the bond, we issued at a premium. And when we issued it at a premium, we created a second liability account and we credited that liability account. Therefore, if I want to lower the liability, remember we're talking about that premium account. If I want to lower the 3,600, I'm going to do it by debiting bond premium by 900. So that will be bond payable premium, and I will debit that 900. And then the interest expense is the plug. The last thing I do would be to calculate interest expense so the journal entry makes sense. So I've got 6,000 in credits and I need 6,000 in debits, and therefore 6,000 minus 900 is 5,100. That's what the journal entry looks like. And it will be this journal entry for all 4 interest payments. It's going to be the same thing.